Well, we're here with Paul Wetton at American Life, and they do private financing here in Arizona and throughout the country. And so we're just going to spend some time learning a little bit about their program, and maybe you could just start off, Paul, walking us through a little bit of what you guys do over there, and we'll go from there.
Absolutely. Absolutely. So American Life Financial is a wholly owned subsidiary of a life insurance company. So as a result, we have our own funds to lend. We're not getting funds from investors. We have our own pool of funds that we lend. Our loans, we loan in the Western United States. And I don't know if there's a way for me to,
Want
I
me to give
can
you a
actually
short
pull
screen?
up if you can give
Yep,
me an opportunity.
you have access, so go ahead. I just gave it.
Okay, so I will share my screen. So what can you all see? Can you see that now?
Yes.
Oh,
Yep.
okay. You're looking at okay, here we go. So here's our rate sheet. You can see here our lending area. We lend throughout the Western United States. So Texas, West, and up just south of Canada. Our loans, we do primarily general commercial properties. We're looking for warehouses, offices. We'll also do loans on mobile home parks, RV parks, self-storage facilities, auto repair shops, auto sales facilities. So just kind of any type of property where there's going to be a general market for it. Our loan program will loan as low as $250,000 and will loan up to $3 million on one loan. Our rates, we have three different terms. We have our standard term, the one that we do the most, is our 5-year classic. And this is a regular term loan. So at 5 years, the loan comes due, and payments for these loans are amortized between 20 and 25 years, and in some cases 30 years, depending on the age of the property and what we work out with the borrower. Our rates for the 5-year classic will go up to 65% loan to value on properties that are located in a major metro area. And the way we define a major metro area is if it has a population of 500,000 people or more in a compact area, we'll consider that a major metro. So you have some of the outlying cities around here in the Phoenix metro area. As long as it's connected to Phoenix, then we would consider that part of the major metro area. If it's off in the Tules by itself, like Casa Grande or something like that, now then we look at it on its own merits there. But for a 65-year term in a major metro area, the rate is 8.99%. And then for every 5% less in loan to value that the borrowers ask for, we will drop our rate 0.5%. So if they want 65%, but they could get away with 55%, then we'll do the loan a full percent less for them at 7.99. We'll also loan on minor metro areas, and we consider minor metro area. Say that 5 times fast.
Yeah.
A minor metro area is 250,000, between 250,000 and 500,000. On these rates, we'll loan up to 60% in those areas, but now we're looking at general use properties. We in a non-major metro area, we want them to be general use. We will do some special use properties like hospitality. We will do hospitality loans. We used to do restaurants, but right now restaurants are kind of a dangerous property class for us to be involved in, so we're holding off on that for now.
It's so shocking.
Unfortunately, I know, right? We used to lend on restaurants all the time, but when we discovered that they could be closed by executive order, we
Yeah.
decided to kind of pull back on that. We also have interest-only loans, and we do a 2-year bridge and a 1-year bridge. Our 2-year, the interest rate starts at 7.99. So at the end of 2 years, they can either refinance the property, or they can, for 1 point, we will allow them to extend it 1 more year. So that's an option for them. But again, basically for our 2-year bridge, you take all of the interest rates for our 5-year classic, drop it 1 percentage point, and that's the rates. So kind of easy. And again, same thing, we'll do up to 65% loan to value, and for every 5% less in LTV, we'll drop the interest rate half a percent. And Dave, this might be a little new to you because we just lowered these rates across the board recently.
Yeah, I was going to say.
So this is a new rate sheet for us.
That's great.
So that's our 2-year bridge, and then our 1-year bridge will go for 50% loan to value, general use property in major metro. Our rate is 5.49%. So that kind of gives you a basic idea of our terms. For the 1-year bridge, also they can extend. They have 2 6-month extension options for a point each. So if they wanted to just extend it for a full year, they just pay 2 points and off they go. We are also, for our 5-year classic, we'll also allow extensions for that. But because we're looking at longer term, it's 2 points, and we'll extend 5 years. But that's not a guaranteed thing. If they haven't been good borrowers, then we don't want to extend the loan. We want them to refinance and get us out.
Yeah.
So any questions about that?
Yeah, I do. Thank you, by the way.
Sure thing.
So in terms of the types of deals that end up coming into you then, Andy, is it people that just sort of for some reason have either credit issues, or what's the situation?
So that's our loan program. Let me tell you a little bit about how we lend. When we look at a loan, we are primarily talking about what is the asset, what is the value of the asset, and that's why we loan the LTVs that we do. Because if somebody has a 400 credit score, we may raise our eyebrows a little bit, but if we've got good equity on the property, we'll still do that loan all day long and twice on Sundays.
Okay.
So that's, I guess a good way to describe us, and the reason we call ourselves Not So Hard Money, is because we operate in that space between true hard money.
Yep.
and banks. So we are going to require some documentation of ability to pay the loan and so forth, but credit, ugly properties, we're still willing to lend on that kind of thing.
So Paul, then, like, give me an example, or give us an example of, because when you say collecting documentation, let's say, your typical small business owner doesn't show a lick on his tax returns, but you can see that his rent roll and leases are there. I mean, are you able to sort of walk us through?
So if the property is leased, if it's an income generating property, we're going to want to see rent rolls.
Yep.
And we're going to want to see a copy of the leases, and we're going to verify that this is legit, it matches with the rent roll.
Yep.
And then with that information, we want to see, to get a 60 or 65% loan to value loan with us right now, we want to see a debt service ratio of 1.2. Now, if the guy's personal finances are trash, but the property itself debt services, we'll still do that loan.
Okay.
We don't want to do a loan where it's obvious that we're going to take the property back.
Sure. Yeah.
So if we can make a good case now, debt service ratio, if we've got a really low LTV loan, so for example, earlier this month, we closed a loan and the borrower didn't owe anything on the property, but they needed $800,000 cash out. We were at 27% LTV. We didn't care about his income. We're like, fine, whatever. We can't get hurt on this loan, so we'll do that. And surprisingly, we actually have a lot of those that come through.
Yeah, I'm sure.
So if they've got good equity position on their property, and they don't have, even if they don't debt service, if we've got a good, strong equity position in the property, we'll still consider doing the loan. And you know, I should say this, when we do our underwriting here, we have a couple of really, really good underwriters that have worked for us. Dave, you know Anthony, right?
Absolutely.
He's really, really good. We front load a lot of the research when we do loans. So with some of the lenders you get, they will, you know, they'll get you a term sheet real quick, and then as they start getting more into the due diligence part, they're going to change the terms and conditions of your loan, and the loan that the borrowers wind up getting at the end of the process looks significantly different from what was disclosed on the term sheet. Over 90% of the loans that we issue a term sheet for close under the conditions of the term sheet that we issued.
Okay.
So we spend the time to get to know the property, and we look at the rent rolls and things like that beforehand, so that when we give you a term sheet, we can stand behind it and say, yeah, this is what we're going to do. So that's one of the ways that we're a little different than our competition, but we found that it works really well for us to invest that time up front. And the other thing is, we don't take any money from anybody until they accept our term sheet. So we've done the research, we've looked at it beforehand, so we make sure that it's worth it. They clearly see what they're going to get for a loan, and they can see, is this worth my time, before they send any money our way.
That's great. Yeah, it's good. And then, so, you know, walk us through a little bit of the process. You know, one of my guys calls you up, you know, what do you want to see? And then what's sort of the process?
Absolutely. So when you bring a loan to us, the first thing we want to know, we try to establish the value of the property. So first thing, we need to know the address of the property. Some other important information, obviously, we'd like to know who the borrower is, and are they holding the property as part of an LLC, or are they holding it in their personal name? How are they holding the property? Is it a purchase or is it a refinance? If it's a refinance, what is it that they're going to use the funds for? Are they doing any rehab? Are they, you know, investing it in their business to expand, getting more equipment, whatever it is? The other thing, one of the things that helps us establish value for the property, if it's a refi, is to understand when they bought the property, how much they paid for it, and what capital improvements they may have put into the property. So if I've got a property that the guy, and this happens a lot, I'm sure you've seen it, the guy buys the property in July, and December that year it's doubled in value, right? And so they want to get all their money out. When we do a loan, we will not value that property more than what they paid for it if they bought it within the last 2 years, plus any capital improvements they've made. So if I buy a property for $1 million in 2019, and I put $250,000 in capital improvements into that property, the most we will value that property for would be $1.25 million.
So the period of time is between, for the 2-year period or earlier, correct?
Correct. Now, if it's past 2 years, then we're more open to, okay, what's it worth on the market?
Okay.
Because after 2 years, it's more reasonable to say that it's increased in value for significantly more than their purchase price. That's a possibility. Now, we do also take into consideration the market conditions and the condition of the property when it was purchased. If it was bought in foreclosure, obviously they're going to pay less for it than market price, right? And so if they can document that that's how that took place, then we're open to the possibility of valuing it for more. So anyway, went a little far afield there. So when they purchased the property and how much they paid for it, and any capital improvements they've made are important considerations. So be sure we have that information. We also look at, you know, rent rolls. If they've got a rent roll, if they have leases, we can look more on the back end, but a rent roll up front and a profit and loss statement for the business for the last full year and current year to date. If they have tax returns for business and personal, that's great. That also helps us come to a decision. But with the information that I just disclosed, you know, the property purchase date and any capital improvements, the profit and loss statement, rent rolls, if they have any, if they're purchasing this, a copy of the purchase contract, so we can see what they're purchasing it for, those types of things. With that information, generally we can get a decision made.
Do you do vertical construction then, Paul? Or not?
We only do a limited amount of rehab because we are an insurance company. We are statutorily limited in what we can do for construction.
Okay.
So we strictly do rehab, and that's kind of on a case-by-case basis.
Okay.
But generally speaking, when we do, if there is some significant rehab that has to happen in the property, what we will ask is, so we'll do the loan, we'll want a contractor's bid for the rehab that's going to happen. We will hold back, or they will need to put into escrow 110% of the contractor's bid. Okay. And then we do a draw schedule. And as they get the work done, we either pay directly to the client, to the contractor, or if our borrower has got a mechanics lien release from the contractor and a receipt that shows that they paid it, then we can release that directly to the borrower too.
That's great. And no prepayment penalties, or is there?
There are no prepayment penalties on any of our loans. Great.
And what's, you know, realistic? So once all that stuff comes in, then Paul, what's the turnaround time to get a decision? And is that,
so,
yeah.
So you get that information to us. Realistically, 24 to 48 hours, we can have a decision for you. If we don't have that information, we can't really make a decision until we have it. So if that holds us up, you know, don't hold us to the 24 hours. Sure. But if you give us all that information, we can usually get a decision back to you within 24 to 48 hours.
And then once you do that, is that just considered a term sheet at that point?
So what happens is when you give us a loan scenario, our underwriter will go through it. And they'll say, okay, we can do either, yes, we can do what they're requesting, or we can't do what they're requesting, but we can do this instead. Like, we can't do 70% loan to value, but we could do 65, and we'll work with the broker to see if that will work for the borrower. If we think that we've got a loan that the borrower is going to agree to, then we have an investment committee meeting. We have one every afternoon, and the underwriter presents the loan to our investment committee, and the investment committee gives it an up or down, or yeah, we like it, but put these conditions on it. And then we authorize the issuance of a conditional loan approval at that point. Okay. Our underwriter will communicate with the borrower, hey, we're going to do this. Here's the terms that we're going to do. Excuse me. And then we have to have an appraisal for all of the properties that we do loans on. So we will get an appraisal quote, and as soon as we have that quote, we'll issue the conditional loan approval. But we will let you know that that loan is approved before we issue the CLA. Okay. So you'll have that information.
So once you have the CLA, they sign it and send in a deposit at
So
that?
they sign it and send in a deposit. So what we take for a deposit is the appraisal, and that's a strict pass-through cost for us. We get a quote to know what's it going to cost us. That's just added to the CLA, and then we charge 10 basis points of the loan amount with a minimum of $1,000 as a refundable loan deposit.
Okay.
And if we have to have anything like a phase 1 or phase 2 environmental report, we will also include that as something that needs to be deposited up front.
Got it. Okay.
Then, so the borrower that signs our CLA sends us the signed CLA with the loan deposit, and we will now get to work on finishing our due diligence, preparing loan documents, getting the appraisal ordered, opening title, all of that. Typically, we can get a loan closed. About 64% of our loans close within 3 to 4 weeks of us getting that signed CLA. So we're able to turn we can turn and burn pretty quick. Sometimes the appraisal may cause a delay, and if we can tell that the appraisal is going to cause a delay and we feel pretty confident with our value of the property, we can proceed. If they'll just give us a verbal, this is what we think it's worth, we can sometimes proceed and close the loan before we get the final appraisal report. But that typically when we don't close within 3 to 4 weeks, the hangup is usually the borrower has not given us information we've requested.
That's good.
But we closed probably the most complex loan we closed was 60 plus properties in one loan, and we did it in 2 weeks.
Yeah.
So if we've got a cooperative borrower, we can move things.
That's great. And then the fees you said are.
So we charge 2 points,
right,
plus 2,500 in underwriting and inspection fees.
Okay.
We have one of our employees physically inspects every property that we loan on.
Okay.
If we decide after we've looked at a loan and we're like, yeah, you know what, this is not what it was presented to us to be. It's different than what we thought it was, and we decide that we're not going to do the loan, we will refund the deposit back to the borrower minus any actual expenses we've had. So if I've already sent my employee out there to look at the property, he goes in and he sees that it's just an enormous petri dish of mold. So we'll deduct his plane ticket cost from the deposit and refund the rest of it. Okay. When we close the loan, when we fund the loan, we also refund the deposit at that point too.
Okay. And so what are the kinds of deals that you've been getting done over the last 3 months?
You know, it has been a really interesting year for us. We've done, let's see, the last 2 loans we closed were luxury single family residences over in Texas. Okay. We did a spec home in Spring, Texas, and then a former NBA player's residence in Houston.
Huh.
Yeah, that was kind of interesting. That we did that, but we're working on a lot of. We've seen several medical offices, a general office space right now. In my pipeline to close, I've got 3 or 4 warehouses, a medical office building, an event center, a rodeo event center, which is that's very atypical. That's very atypical for us to have something like that. But hey, you know, it's cool. What's been really interesting is that our average loan amount has increased significantly this year over past years. Last year, our average loan balance was about $800,000. The year before, it was over the last 5 years, it's been about $600,000 is our average loan. This year it's like 1.1 million is our average loan amount.
Oh.
Yeah, and which is almost counterintuitive when you think about what's been going on in our economy, but there you have it.
Yeah, that is. Yeah, okay. And so, yeah, that kind of gives us cost structure, methodology, things of that magnitude. And then do we just end up putting our fee, we just have our own fee
Yes.
signed, and then we just
So
submit that in there?
when you give us the loan scenario, one of the things that we should be asking you every time, and if we don't ask you, we will call you back before we issue the CLA to get your points. What are you charging?
Right.
And some brokers charge, they charge points plus fees. So if there's any of that going on, we need to know that, because that is included in our conditional loan or loan approval letter. So they can see exactly what they're paying in that. That's the goal there. The other thing that we offer, and this is something that several brokers have taken advantage of, is we have what's called broker participation in the interest rate. So if we do a loan at, say we do a loan and we're going to give them an interest rate of 7.99%. If you sell an interest rate of 8.49% to that borrower, then that additional 0.5% that was added to the loan is paid to the broker every time they make a payment. And there's no cap on the number of those you can have. We have several brokers that have multiple loans that they're getting this on, and every month we cut them a check for the interest that has been paid on all those loans. So that's also an opportunity to make a little more residual income over the life of the loan. And that's payable as long as the loan is being paid on. That's paid out to the broker. So that's also an opportunity to make some money for you.
Well, this has been really helpful. We appreciate you taking the time, and I'm certain that over the next couple of months, we'll probably be giving you a call. So
Fantastic.
Thank you so much, Paul. We appreciate
Dave,
taking the time.
I'll send you a copy of our rate sheet.
That'd be fantastic.
So that you can spread that around, and I'll also send you a list of here's what we ask when people submit things, so that you have all that information at your fingertips.
That's great. Thanks for your time.
Okay.